So today we're going to talk about investing, which I would say, okay, if you're a bunch of business majors, maybe it sounds interesting to you. But I would say, like in general, for people of college age, it sounds really incredibly boring to like 50% of people. And then the other 50% are like, yeah, I'm really into investing. That sounds cool. I want to get super into that. So I am going to go through with you for the first half of this, the sometimes considered boring parts of investing, the learning part, where you have to actually, define terms and learn what they mean. Then the second half, I promise, every person in this room will be at least somewhat interested in, because it is very much going to apply to your life. So I swear, it gets better. It gets more interesting if you're bored at the front. So let's get into it. I'm going to open up here with a little quiz question, a little poll. If you were to randomly invest $10,000 in the stock market 50 years ago, that is 1971, including bad stocks and good stocks, you're investing just kind of randomly, just spraying your money out there. Even businesses that you don't know are actually going to go out of business later. And some are going to become like the next Apple. You just have no idea what you're investing in. You're just spreading it out there. What do you think that money would turn into if you just kind of let it ride with that randomized strategy today? How much money do you think that would be? So just take a guess. $10 million. Yeah? $8.5 million. We're turning $10,000 into $8.5 million. What did you say? $380,000. That's 38 times our initial investment. Still pretty good. You got a guess? $500,000. Yeah? $50,000, 5 times our original investment. Anybody else want to throw a guess out there? $250,000. Going once, going twice. All right, the correct answer is, if you took this strategy 50 years ago, today you would have about $1.8 million just by literally throwing darts at boards and picking stocks like that. Okay, just total random stock picking like a monkey could do. All right, so cool strategy. If you want to be the coolest grandparent ever, if you invest $10,000 of your own money today, then your grandchild can be a millionaire when they are roughly your age. You're definitely going to do that, right? Yeah, no. What's up?
My grandparents actually did that. They did like some super stuff.
What?
We don't.
Are you a millionaire? They didn't do this. Hopefully that's exciting to you. I mean, some of you guessed $10 million, so maybe this is not exciting at all to you. But I think turning $10,000 into $1.8 million by doing basically nothing except wait 50 years is pretty incredible. And you can kind of do the math on what that would be if it was more than $10,000. It would be a lot more than $1.8 million. So that should get you exciting. That's the stock market for you. But stocks are not the only thing you can invest in. So we're going to talk about different stuff you can invest in, what it all means, and why you choose one over the other. So you got stocks, also known as equities, bonds, also known as debt. You got real estate, commodities, you got savings account, you got tons and tons of other stuff that I'm sure you've heard of. You got cryptocurrencies, really popular right now. You can invest in other countries' foreign currencies, collectibles. There's millions and millions of things you can invest in, all with the same goal, make money, right? So let's go through a few of the main ones. But first, let's talk about how we're going to be sort of hypothetically investing in this presentation, all right? So we're going to use a strategy called index investing. And index investing basically means that your money gets invested in a whole bunch of different things all at the same time, kind of, sort of, randomly. Like the most broad index in the United States tracks every single publicly traded stock in the United States. So if you invest in this thing called an index fund, you're buying a little tiny piece of every publicly traded company in the United States. And you can even do one for the whole entire world. And you can do one for bonds, and you can do one for real estate, and all sorts of stuff like that. So it's kind of randomly throwing your money out there. You're not picking which specific companies you think are going to do better or worse. You're just throwing your money out there, letting it ride, and hoping for the best. That sounds kind of like a stupid strategy, right? But think about that previous example we just went through. It must not be that dumb. It turned $10,000 into $1.8 million. And it actually turns out that this whole index investing thing is a really, really good strategy. It's actually one of the strongest possible investing strategies that you can do. And there's a few reasons for that. Number one, it is really easy. Anyone can do this strategy. And because it's so easy, it means you're not spending your whole day trying to research stocks and pick which one's going to do better than the other one, and wins and loses and spinning roulette wheels and crazy gambling stuff. You're just going to spend your time going to work and actually making money because, newsflash, you actually have to have money in the first place in order to invest, right? So you spend your time actually at work earning that money, which you can invest. Also, the people who do kind of hunch over their computer all day and do active trading and try to pick out stocks, research has shown time and time again those people on average underperform this random index strategy by a lot. And also, you can pay someone else to do the hunching over a computer and trading securities for you. But to do that, you have to pay a fee, a management fee. And the management fees are very low for these index funds versus paying someone to do that for you actually ends up costing you more. And it still ends up underperforming the index on average. So that's not a great strategy either. So when you compare this index investing to the other strategies that are available, it actually turns out to be, in my opinion, basically the best strategy there is. It also diversifies you, like I said, thousands of stocks, and you're just generally forced to be a little calmer and not care so much and spend all your time on investing and stuff, which I think is a good thing. So let's go through the different types of investments, what they all mean, and then we'll figure out, what should you actually do. So stocks, basically, if you don't know, when you buy a stock, you're buying a little piece of ownership in a company. There's two ways to make money on stocks. Number one, if the company becomes more valuable over time, that's called appreciation. The stock gets more expensive, you could sell it later for a profit, right? Number two is a lot of stocks pay off dividends. They just basically send you a check electronically nowadays every month or quarter or half year or whatever it is. And that's just a little piece of their profits that you're entitled to as a company shareholder. So if you invest in stocks, and again, we're talking about this index strategy, just in general, long-term index strategy. If you invest in the stock market, the average total return, the appreciation plus the dividends together, has been about 10 to 11% per year over the last century or so, okay? But to get that return, because 10 to 11% per year is actually a very high return. So to get that return, you have to bear a lot of risk and a lot of volatility. So that means that your stock portfolio, it's not going to be a nice straight line that just goes up over time. It's going to be a crazy wavy line, and you're going to have to see your money disappear and reappear and disappear and reappear and go down and up and down and up. So you have to kind of stomach that pain to hold stocks, but you get a nice big fat return in the long run in exchange for that. And that kind of works for a lot of investments. The more risk you take, the more reward you can expect to receive. So a lower risk thing is bonds. Bonds basically is where you're lending your money to somebody, usually a corporation or a government. And so when you buy a bond, you're providing a loan. That loan pays interest over time. So that's the main way bonds make money. They're much safer. If you lend money to the US federal government, you're probably going to get your money back plus interest. They're fairly trustworthy in that respect, at least. So the risk is pretty low with bonds. So you will see more of that steady growth. There's still a little wiggle, but there's still steady growth. So a really terrible crash in the bond market would be like minus 15%. That would be like a financial meltdown in the bond market. It would be like if you lost 15% of your money in a year. Compared to stocks, where you can lose 60% in a really, really bad year, it's definitely lower risk, right? So lower risk, lower return. The stock market's not the only high return investment. There's also real estate. Most people are pretty familiar with this. If you rent an apartment, you are part of the real estate market, because guess what real estate is? It's basically just buying up properties and renting them out to other people. You collect the rent, right? If you collect the rent, that's your investment return. There's also the fact that the house that you own or the apartment building or office space or whatever you own can appreciate in value over time, can get more and more valuable. So you get both of those two things combined. They give you a return that's pretty comparable with the stock market, 10 to 11% per year. Maybe a little bit more if you use mortgages and leverage, but you take a little risk that way. But anyway, this is a high risk, high return investment, just like the stock market. And in a bad year, I don't care what older people tell you. A lot of times the older generations will tell you real estate's like the safest investment there is. It's not really true. If you look back in history, there have been plenty of real estate crashes where your house's value can evaporate 50 or 60% in a year, just like the stock market can. So real estate's risky too. Don't let anybody fool you, but it has a high return as well. Those are your three main investments. But of course, there's another place you can keep your money. It's probably where most of you are keeping your money right now. Everybody does to some extent, which is in cash. Just money in a savings account or checking account or in your pocket. Right now, the best return you can get on your cash in a bank account is around 0.5% per year. In the past, that's been a little bit higher. Right now, it's really low, but about 0.5% per year. The good news is, if there's a huge market crash, of course, your cash doesn't just magically go away. It's not an investment. But the bad news is you're earning a teeny, teeny, tiny return on that. So we'll talk a little bit more about that later. By the way, side note, okay, action item from today, if you wanted to go home and do something really, really easy to improve your finances a tiny little way. Whatever savings account you have at your current bank is probably paying really, really bad interest. Does anyone in this room actually know the interest rate on their savings account? Yeah?
Mine is 0.5 because I have a high yield.
0.5 because you have a high yield savings account. So that's the kind that we're talking about up here. I'm talking about like the best kind you can get, 0.5%. You're actually doing pretty well in today's market. Does anybody else know their interest rate? If you don't know your interest rate on your savings account, it is almost definitely between 0.01% and 0.1%, okay? Because most of the big banks, that's what they pay, is effectively zero interest because most people don't check. They don't look, right? Nobody in this room except one person knew their interest rate. So if you don't, there's 3 banks right up here. They're all FDIC insured, and they all pay close to that 0.5%. So at least you can get the market rate on your money. And hopefully, one day if interest rates go up, you might get a little better than that too. But with all that said, right, all that exciting stuff, turning $10,000 into $1.8 million, all these exciting, fancy investments, that's not quite 100% true, everything I told you, because of inflation. And actually, inflation's been getting a lot of press coverage lately. You've probably heard something or another about it at some point in the last 6 months or so. So it turns out that, they print more money all the time. Government prints more money all the time. And for other reasons as well, the average price of goods goes higher over time, right? So for various reasons that happens. That means that your dollar buys less and less every single year. So even if you have $1 today and $1 next year and $1 the next year, it doesn't buy the same stuff. They're actually talking about, I read recently that the Dollar Tree is going to have to start finally having items that are more than $1 because they can't afford to keep up with this inflation. This year they're planning on making a big change. They've been like the last holdout for the real dollar stores. Because Dollar General is not like a real dollar store, right? Like if you go to Dollar General, they have like $5 items. That's a lie. But Dollar Tree, I always love Dollar Tree because everything's legit $1. So they're changing that because of inflation. But anyway, if we go back to those returns that we were talking about earlier, inflation has averaged around roughly 3% per year in the long run. So our stock return, which is 10 or 11%, very exciting, is really only effectively 7 to 8% a year after inflation. That's called the real return of stocks. Real means after inflation. So bonds are really only down to 1 or 2% per year, real estate 7 or 8, and then look at cash. That is a negative number. So when you hold cash in your savings account and you earn interest on it, you are losing purchasing power over time. And that is one of the main reasons why investing is super, super important. If we revisit our example from before, invest $10,000, 1971, 50 years ago, how many times more buying power will we have today compared to back then? So before, just kind of to recap what I'm asking, before we said our $10,000 turns into $1.8 million, right? That's 180 times as much money, as much dollars. But my question is, if you could buy, X cars in 1971 with your $10,000, how many cars can you buy now with that same amount of money? In other words, how many times did you multiply your buying power? Multiply your money by 180 times. How many times did you multiply your buying power? Does anyone have a guess on that? 25 times as much buying power. Okay. 15? Anybody else? Throw out a guess? So 180 times more money, you actually wind up with 27 times more buying power. So if you could buy one of something 50 years ago, you can now buy 27 of them today. That's not as good as 180 times, but it's still pretty exciting, right? You literally 27x'd your money in real terms. So it's still very exciting, still very good to invest your money over the long run, just not as exciting as before. Here's a couple examples in a chart, all right? So stocks versus bonds versus cash. Check this out. Stocks, we said, 27x'd our money over the last 50 years in an index fund. In a bond market index fund, we 3x'd our money over 50 years. We had to wait 50 years to 3 times our money. I mean, that's good, but not anywhere near as good as 27 times. If we kept our money in a savings account and earned interest on it, we would have less effective buying power than we started with the day we put the money away. So we got paid a negative effective return after inflation for keeping our money stored away in a savings account. So a lot of people say that investing is really scary and really risky, and it's true that there is risk involved in investing. But if you think about it this way, what is really the scariest place to keep your money? In a bank account, basically, right? You're almost guaranteeing you're going to lose money over time. With this investing stuff, if this gets you excited, I hope it gets you excited, you might be like, well, okay, I got to go home and I got to transfer all the money out of my savings account and I got to just invest it all right now. I'm putting it all in the stock market. That's cool. I'm glad you're excited about that. But I should probably tell you that you might have another really good investment opportunity that we didn't talk about available to you. So if you have debt of any kind, student loans, credit cards, anything else, car loan, whatever kind of debt you might have, you can always consider that an investment opportunity as well. Because if you take your money and put it at that debt, you're eliminating future interest that you would have to pay on that debt, right? So if you take your money, throw it against your debt, you're reducing your interest payments. So here's a little hypothetical for you. Let's say you have a student loan right now, and let's say your rate on that student loan is 6% per year. My question for you is, if you had $10,000 laying around right now, which would be nice, would you rather pay off $10,000 of your student loan right now, or put the $10,000 into the stock market? Does anybody have like an answer for that? There's not really a right answer. I'm just curious to hear your reasoning. Yeah. You would pay off your debt. Why would you pay off the debt? Like, what's your reasoning behind it? So it doesn't grow and accrue interest, right? Okay, so yeah, so that's the benefit to paying off the debt, right? If you throw the $10,000 against the debt, that's $10,000 of debt that is not accruing 6% interest a year for the rest of the term of the debt, right? So that's definitely a benefit, yeah?
I would also pay off.
She would also pay off the debt. What's your reasoning?
Because the average return is still around 6%, so you might as well pay off your debt. And then, yeah.
Okay, so you're comparing that 6% to what? The return of the stock market? And you're saying, listen, the stock market doesn't return that much more, so I might as well invest in the debt. What is the advantage of investing in the debt versus the stock market? Like, what's the difference there that's making you go toward the debt if they're similar?
I'll feel better.
You'll feel better about it. Okay, so like a psychological or emotional thing. Okay, cool, yeah?
I feel like as just like a finishing college, you don't have that much disposable income, so you'd rather pay off the debt than like risking more and potentially screwing yourself over in the stock market.
Okay, so not having disposable income in college, feeling safer maybe about throwing it at your debt, it's a sure thing. I think that's kind of like the underlying sentiment here, right? Is if you were to pay off the debt, it's interesting to hear 3 people in a row say pay off the debt. It doesn't usually work like that. But yeah, if you pay off the debt, there's definitely an advantage there of you are guaranteed effectively a 6% return, because that's interest you were definitely going to have to pay, and now you don't, right? Also, by the way, the 6% that you get by paying off your debt is not taxed. The IRS doesn't tax you on money you save by not paying interest, right? But they do tax you on gains on things like stock market and bonds and stuff like that, right? So there are definitely advantages. But with that said, some people, nobody in this room said it, so I'll say it, some people would say, no, just go, you're young. Just go into the stock market. It has a little bit higher return than that 6%. And so you can make a profit on the difference there. Just keep paying the interest, the 6%, and collect that 10 or 11% return on the stock market. You're making a profit on the difference. That is a fair thing to say. It is true that on average it works out like that. But as the people in this room pointed out, there's additional risk that comes with that as well. So it's always a trade-off there. Now, if you had 15% APR credit card debt instead of a student loan at 6%, does everybody in the room agree? It is clear you should pay off the credit card debt. There's no point in throwing in the stock market. You're probably not going to earn 15% per year on average in the stock market, and it comes with risk. It's no risk to pay off your credit card debt. So if you have super high interest debt, like credit card debt, you want to get that done fast. You don't want to mess around with that. Like, there's almost no question about it, right? So yeah, that concludes what I called the boring part of the presentation. All right, that's the background info. That's the stuff you just got to know. So All this time, we're talking about money. And some people are really excited about money. They're like, yes, I want to get rich. And other people are like, what's the point of that? I don't really care that much about money. I care about other stuff in life, whatever. So we should probably ask ourselves a question before we go any further, wasting our time learning about this stuff. What's the purpose of accumulating money? Why should you want to get rich in the first place? For some people, it's really obvious. You do it to buy more stuff. If you're super rich, you could have a private jet like this one, right? Easy. But I think a lot of times people miss that there's another purpose to money as well. All right, so it's not just about buying more stuff. Yes, I obviously acknowledge you can buy more stuff if you have more money. But there's a second possibility. What if instead of buying more and more stuff, which honestly, let's be real, like we're all alive and breathing and eating and we have water and shelter over our heads and stuff. So what if instead of buying more stuff that we don't actually need, what if instead we bought the same amount of stuff as we're buying today, and then over time we became financially independent? All right, and so I'm going to give you a definition for that term. Financially independent, when you think of that, you might be like, okay, I'm independent. That means I don't have to like ask my parents for money, right? It's more than that. Here's what I mean by financially independent, okay? Financial independence means earning sufficient money via investment returns to fund your lifestyle indefinitely without any other source of income necessary. So that basically means if you wanted to, you could just quit your job and you'd keep getting paid enough to live your life forever, okay? A lot of people would just call that early retirement. It's a pretty simple term for it, right? But I do want to point out, once you're financially independent, once you don't need a job anymore, that doesn't mean you have to quit your job or you can never ever do work again for the rest of your life. It just means work is optional. You are buying freedom, okay? So bottom line here is money can buy two things. It can buy stuff and it can buy freedom. And most people miss that the second thing even exists as an option, okay? So that's what we're going to talk about. So obvious question, how much do you need? $10 billion to do this? Like, how much do you need? The answer is pretty easy. What you do is you figure out how much you need to spend in a year to be happy, and you multiply that number by 25. That's how much you need to be financially independent. It's called the 4% rule. Basically, here's how it works. You're aiming to get at least a 4% real return after inflation on your money. I'll prove it to you. It's pretty loose proof, but easy, quick proof for you. Let's take the average stock market return from earlier. Before inflation, the original stock market return, what was the number? Who was listening? 10 or 11%, 10 to 11%. Average bond market return, how much was that before inflation earlier? 4 to 5%, 10 to 11, 4 to 5, okay? So if you had a 50-50 portfolio, that is half stocks, half bonds, when you decided to retire or become financially independent, what would your average return be before inflation? 10 or 11, 4 or 5, what's approximately the average there?
7.5.
Yeah, around 7.5, right? Now, how much did I say inflation was in the long run? 3. 7.5 minus 3 is? 4.5, which is just a little more than 4%. That's the required amount to be financially independent, right? That's the required real return that you're seeking. That's where that 25x comes from. It's 1 divided by 4%. Okay, so hopefully that kind of makes sense of it for you. So how much do you need? Well, let me give you a real life example. My wife and I, in the past, during like our working years, we spent $18,000 to $22,000 per year combined for both of us to live. So let's call that 20K for easy numbers. Okay, so we spent 20K a year for 2 people. So 4% rule. If we multiply by 25, that means we needed $500,000 in addition to our paid off house, because we had a fully paid in cash house that we bought very early on by saving really hard for the first couple years. So paid off house to get our expenses down really, really low, and $500,000, and boom, we're financially independent. We don't have to go to work anymore for the rest of our lives if we don't want to, okay? So let's suppose that our after-tax income combined together was 100 grand, all right? So 50K each for 2, UF grads after tax per year. That's a fake number, but it makes the math easy, okay? So 100 grand. So that means 100 grand minus our 20K in expenses. We had $80,000 every single year doing nothing. There's no purpose for it. We don't need it to buy more stuff because we were happy with the amount of stuff we had. We have $80,000. What are we going to do with that money? Invest it, right? So that's exactly what we did. So $500,000 divided by $80,000 per year extra cash, that's 6.25 years to retirement, basically. It's actually a little bit less than that because if you invest along the way, you actually earn some return on that money. So it brings it down just a little bit. But I am 31 years old right now. Feels weird to say that. But if I had $0 today, if I started right now from zero, I could be financially independent by about 37. Okay? I did not do that. My wife and I started around the time that we were graduating college, which is why I like to come and present this to people who are soon to be graduating college. So if you start younger, you can become financially independent younger, and you can be free to literally follow whatever passions you want, do whatever you want with your life, whether that's work, or work a little bit and do other stuff, or travel the world, or do charity work, or follow your passion, or become a professional skateboarder. I have no idea what your dreams are, but you can do whatever they are if you're financially independent, because you don't have to worry about money, and you don't have to show up for work if you don't want to anymore at any point. Yeah, so it's really not just sitting on the beach all day. That's not a very good picture for this, actually. Obvious question, like it's probably in all of your minds, is like, how do two people live on $20,000 a year? Like that doesn't really compute. So that's the unusual part. And sorry to burst your bubble, but like that's the most important part, is getting the expenses down low. But here's some tips, like here's some stuff that we did. So we've always shared one car between the two of us, which is kind of unusual for a married couple. And we always bought them used. And to give you an idea what I mean by used, I think the average price that we paid for a car throughout our driving careers was under $4,000 per car. And we shared that car between two people. I rode a bike to work, which is really good for my health and my attitude when I arrive at work. So like, I highly recommend it for non-monetary reasons, but by the way, it helps you get really rich really fast. And we saved enough in the first 2 years of work to buy our first house for cash, which dramatically reduced our expenses as well by eliminating rent from our lives. Don't have to rent anymore after the first 2 years. Cooking at home, obviously it's pretty cliche, but that's an obvious thing. Cooking at home, I like to cook at home. And I kind of like Taco Bell, which, you know, is not that expensive either. And as far as hobbies go, you know, a lot of people say, well, what do you do for fun? But you can actually pick hobbies strategically that actually can make you money instead of costing you money. So like the giant camera in the back right there, I don't just have that for fun. That actually was my side hustle for, well, I guess technically it still is my side hustle. For the last decade or so, my wife and I have done professional photography, made way more money than we ever spent on that camera equipment, and then I get to have tens of thousands of dollars of cool camera equipment to just play with whenever I travel as well. So you can pick hobbies strategically that don't end up costing you any net amount of money. But really the bottom line here is, any time that we spent a dollar, we thought about spending along the way to financial independence, we said, is this really worth selling our freedom for? Because that's what you're trading. Remember, money can only buy two things. It can buy stuff and it can buy freedom. So when you buy stuff, you're giving up freedom until that point at which you're financially independent. Think about that. People don't talk about this, all right? I would just say to you, you're in college. You're the experts, all right? You're probably better at this than I am at this point. You're an expert on being happy with low spending. That's what college students are known for. If you're happy during your college years, and think about this, every adult, don't they always say, those are the best years of my life, college, right? It's not about the money. The best years of your life have nothing to do with how much money you spend. It's how you spend your time. So buy time with your money instead of buying stuff. Just keep living your college lifestyle. Just keep living the life that you're living right now. If you like it, if you're happy, keep that level of spending when you get your real job, and you will automatically do this. There's like no work involved. But if you level up your spending over time, if the first thing you do when you get your big boy or big girl job is buy a $30,000 car on credit, well then you're just going to be right way behind from the start. And that's what most people do, right? So just think about that. How long does this take? We kind of dove into that. If you account for investment returns, it's actually not 6.25 years for the 80% number, it's 5.6. I do want to go over something here. If you were to change this just a little bit, if you were to save $40,000 instead of $80,000 a year in that same example, you would think it would take twice as long to retire, right? It is not. It is 4 times as long to retire by cutting in half the savings rate, okay? So that relationship is not linear. And so if you take this to the extreme, or what I consider to be the extreme, the American average savings rate, the real average savings rate for American families, is about 6%. If you save 6%, it takes you about 62 years to accumulate enough for the 4% rule without the help of Social Security at the end. You'd be old enough to collect Social Security by then, is really the point. Who wants to work for 62 years straight, full-time? Mandatory. You can't get out. There's no escape. That's the reality for the average American family. And for most people who have a middle-class income or higher, the key to that is expenses. If you just lower your expenses, you don't have to deal with this reality. Caution for you, I told you a bunch about market returns and average returns over the long run, et cetera, et cetera. Market returns are never guaranteed. This plan is not absolutely 100% guaranteed to work no matter what. But I would say this. What if you run out of money, right? That should be the obvious question. Like, Steven, what if you run out of money? Like, you're going to quit your job, and then what if you run out of money? First of all, you don't run out of money overnight, right? If the stock market crashes and I have half as much money tomorrow, but I only spend 4% of my portfolio per year, I still have years and years of runway left. Furthermore, if you retire by the time you're 30, you're not an old, tired person. You could just go back to work anytime you want. You're a young person, right? Plenty of 30-year-olds work full-time, or 40-year-olds or 50-year-olds. You have decades left of work in you if you need it, which is very unlikely to be necessary based on history. But think about the reverse risk, right? What about the reverse? What if you work too long because you're so afraid of investing and running out of money, and so you waste your whole life sitting in an office? That risk, to me, is way bigger than the risks involved in investing.